Welcome to This Explainer. Okay, so how exactly do you unlock hidden billions inside a global energy giant? Today, we're breaking down a really massive move in the global energy sector, taking a close look at Siemens Energy and their historic August 25, 2026 announcement to separate their transformation of industry unit. We're going to dig deep into the data, the underlying strategy, and the valuation metrics to understand exactly how this move aims to unlock some serious shareholder value. This isn't just some administrative shuffle, right? It's a fundamental strategic redefinition of a massive European powerhouse. So, let's get right into it.
Here's our structured roadmap for today. We'll cover the catalyst for change, break down the strategy, look at how this unlocks hidden financial value, check out Wall Street's verdict and the risks involved, and finally, lay out the overarching investment thesis. Let's dive in.
Starting with Part 1, the catalyst for change, a truly pivotal moment for Siemens Energy.
We are talking about 5.7 billion euros. That's the staggering revenue of the specific business being split off. Imagine running a massive entity with 17,000 employees whose day-to-day operations are going to be totally upended by this shift. So why now? Well, it really comes down to wildly diverging end market cycles that simply can't exist in harmony anymore. On one hand, you have an industrial sector facing immense, heavy cyclical pressures that demand careful defensive maneuvering. That reality is completely at odds with a core energy business that is absolutely booming right now and needs aggressive reinvestment. Trying to run both of those distinct beasts under the exact same umbrella was just creating unavoidable internal friction.
Moving to Part 2, breaking down the strategy and focusing on the core. Think about how the total group revenue actually breaks down. The Transformation of Industry Unit, or TOI, makes up exactly 15% of the pie. Now, while that 15% translates to a massive multi-billion euro business in its own right, it's still vastly overshadowed by the 85% core business. Just imagine the day-to-day reality here. When you're only a 15% slice, it's incredibly tough to fight for internal capital, engineering resources, and top-level executive focus. Separating the unit gives TOI the necessary operational independence to actually thrive on its own terms.
The contrast here is literally day and night. On one hand, you've got the core business of grid tech and gas acting as this high-growth engine room. They are seeing an unprecedented surge in orders, largely fueled by the absolutely insatiable demands of AI data centers and broader global electrification trends. It's a high-margin, high-growth environment requiring rapid scaling. Then, on the flip side, you have TOW providing vital equipment to the oil, gas, and chemical sectors. It's an incredibly high-quality business for sure, but it faces natural cyclical industrial pressures. Basically, TOW needs a completely different capital structure and a totally unique risk appetite to successfully invest in its own heavy decarbonization tech over the coming decade.
CEO Christian Bruch really hit the nail on the head here. He said, if we don't change our structure, we limit what transformation of industry can achieve. He clearly gets that without a definitive structural change, the parent company is effectively putting an artificial ceiling on what TOI can accomplish out there in the open market. Keeping these profoundly different businesses tangled up together is actively holding back the industrial unit's long-term potential.
So, what's really driving this? It's something called a conglomerate discount. Basically, this is a scenario where the market values a combined company at less than the sum of its distinct parts, entirely because of the complexity and conflicting capital allocation priorities. When you have a diversified energy conglomerate packed with heavily mixed assets, the stock market generally gets confused. Investors struggle to value a high-growth, AI-adjacent grid business when its financials are consistently dragged down by a slower, cyclical industrial business. Because of that baked-in complexity, the broader market just punishes the stock.
All right, on to Part 3, unlocking hidden financial value. Let's get into the math behind the split.
10 billion euros. Let that sink in for a second. According to Bloomberg and major investment banks, the newly separated toy division alone could achieve that massive standalone valuation. It is a staggering figure, and it highlights exactly how much hidden financial value is currently trapped inside Siemens Energy's mixed bag market cap. By removing that conglomerate structure, this 10 billion euro asset can finally be recognized and priced for what it truly is.
So how does decoupling actually unlock all this trapped value? It boils down to two main steps. First, the market can finally look at the TOI unit on its own and assign it an accurate valuation based on its true industrial peers in the heavy machinery and decarbonization space. Second, and this is huge for current shareholders, it allows the massive core business to finally trade at the premium multiple it deserves. Without the industrial drag, the core can be properly priced as a pure-play growth asset with deep exposure to AI data centers and the global energy transition.
And you know this is a high-quality asset because of the heavyweights circling it right now. We're talking absolute top-tier private equity players: CVC Capital Partners, EQT, Bain Capital, Brookfield, and KKR. When marquee names like these show up and begin conducting diligence on a spinoff, it sets the stage for a highly competitive bidding war. That kind of deep institutional interest strongly suggests the final sale price could be driven way above those initial 10 billion euro estimates.
But here's the kicker. Siemens isn't just taking a check and walking away completely. This is a highly calculated move. By publicly intending to retain a meaningful minority stake, Siemens Energy gets to push the massive debt and operational risks of TUI entirely off their parent balance sheet. But by holding on to that minority slice, they ensure they still capture the future upside of TUI's standalone success. It's kind of the best of both worlds. It gives the parent company singular focus without missing out on the financial rewards of a newly liberated industrial unit.
Which brings us to part 4, Wall Street's verdict and the risks, a consensus versus reality check.
Across the board, the sentiment is overwhelmingly strong buy, reacting to this structural shift. A deep consensus of 25 analysts supports this bullish view, driven by expectations of sharpened management focus, room for future dividends, and sustainable improvements in margins. With revised price targets hitting €245 at JP Morgan, 250 at Evercore ISI, and 215 at Jefferies, Wall Street is effectively screaming that this separation is exactly the catalyst the company needed.
But hey, we have to stay grounded in reality here. There are some very real execution risks that will demand management's attention and capital. First up, they still have to navigate the slow-burning turnaround of Siemens Gamesa, their troubled wind power subsidiary. That operational challenge isn't magically disappearing overnight. Second, separating a multi-billion euro unit in Europe means complex negotiations and approvals with really powerful labor representatives on the supervisory board. Those union dynamics introduce a tangible layer of execution risk that absolutely cannot be ignored.
Finally, part 5, the final investment thesis, streamlining a powerhouse.
Ultimately, this whole maneuver is about scoring a dual victory for long-term investors looking for a highly streamlined play on global energy infrastructure. On one side, you're maximizing the core, making sure that massive AI-driven grid boom is fully priced into the parent stock without any historical industrial drag. On the other side, you're empowering the spinoff. You're giving TOI the true operational independence it desperately needs to chart its own course, fund its own R&D, and attract tailored investors. It is literally a textbook example of addition by subtraction in the corporate finance world.
So I'm going to leave you with this to ponder. Will the sum of the parts truly exceed the whole, or will execution risks stall the entire transformation? The underlying financial logic is undeniably sound, and the private equity interest is palpable, but execution is absolutely everything. Can Siemens Energy navigate the complex European labor boards and the lingering game as a turnaround smoothly enough to fully unlock that massive 10 billion euro potential? Time will tell. Thank you so much for joining me to unpack this fascinating shift in the global energy sector. Keep learning, stay focused, and I'll catch you in the next explainer.